Hey guys, RC Peck here. Thanks for reading my blog this week. And I could not pass up this. I don't even know what to call it. Is it an article? Is it a post? It was just so poorly done and just it came across just so stupid. And look, I am one saying this who spells many things wrong and uses punctuation incorrectly and words are misplaced. So this is not from a grammar Nazi point of view. It's from the whole thing felt really stupid and worthless. And I expect even on Forbes.com to have some level of quality. So the title of this is "Do You Still Need Bonds in Your Portfolio?" It's written by this guy named Simon Moore, who apparently is a senior contributor, whatever that is. I don't really know what that means. But I'm just going to read it because it's not that long. And then I'm just going to think out loud. So while the U.S. 10-year yield, with the U.S. 10-year yield close to 2% and many other government bonds in Europe and Japan yielding negative rates, does it still make sense to hold bonds in a portfolio? All right, not bad. I mean, it's not 2% anymore, but this was done... where's the date on it? Maybe it's about 6 months old, not 6 years old. And then it goes on, the role of bonds. Generally, bonds offer stability and income to a portfolio. In fact, the asset class is sometimes referred to as fixed income. It's pointless. Who really cares? We're just talking about bonds. We're not here to go to school. The main alternative to bonds, namely the stock market, can offer a wild ride in the short term. Okay, again, no one needs to have you tell us that. We already know that. Oh yeah, by the way, guys, I'm in an airport in Oregon waiting for a friend to go to a volunteering event this weekend in Crescent City, California. So I am tired. There's background noise and overhead announcements. But seeing the stock market have over a couple of years is quite possible, and 10% dips can be annual events based on history. It's like, okay, it's useless, it's pointless. I'm still going, guys, because there's a point. Unless you have nerves of steel and no short-term need for cash you've invested, then being all in stocks can be too much risk. Okay, still kind of pointless. It gets worse, guys, and the point that really bothered me is coming up right here. So look, also, though the major stock markets do generally come back from dips to ultimately make new highs, there is no ironclad guarantee that this will always be the case. Now, this is really stupid. This is just bad. It's bad all over. Now, I am thinking of the U.S. stock market, and I'm also thinking of any developed market on the planet, and they all come back. Now, as you know, I'm not a buy and hold or buy and forget or buy and hold and worry. But to say ironclad guarantee, it's like, no, they've always come back, and it's darn near a guarantee that they will continue to come back. And then he goes on and says, both for China and Russia, they've seen their markets go to zero historically. I don't know what century or part he's referencing China. The Shanghai Stock Exchange, the current one came out in 1990. I have no idea for Russia, but they see how their markets go to zero historically from confiscation. It really bothers me how bad and crappy this column is. It basically tells people nothing, but it kind of scares them, saying, look, markets go to zero. So it's taking up people's attention, and I just really hate that. So I'm going to get off this. It felt so stupid. I mean, it's Forbes. I expect a higher standard, but maybe I don't. Maybe I'm thinking of like Forbes from the 1980s. So look, I just wanted to quickly show you the Shanghai Stock Exchange Composite Index. Here it is right here. It came out at the very end of 1990. By the way, you got to go with what's happening today, not what happened in like the 30s or the 20s or whatever this guy was referencing. Now, what he could have said was, look, even the Shanghai Stock Exchange, which is the fourth largest market based on market cap, had a 72% fall in 2008 and 2009. Like, that's huge, 72. then he could have referenced the US had a 58% fall. But I think even better, he could have referenced that the Shanghai stock market fell almost 50%, guys, 50% in 2015 and 2016 over about a 6-month time period. I mean, that's huge volatility. But it's weird to reference China and Russia when talking about US bonds. It's just, okay, it's crazy. All right, now I want to show you something else. I had to get that off my chest. Now, I want to show you US bonds here. So the top half of this price chart is the 10-year US Treasury yield. Okay, so this is what the US 10-year is yielding. And this is a 10-year price chart. We have 10 years of data. And you can see I have these 3 red circles here. This is the 3 times that the yield broke below 1.5%. Now I'm going to scroll up a little bit. And I want to just show you now, when it gets below 1.5, when the yield on the 10-year gets below 1.5, I'm calling that a panic. I'm saying people are absolutely panicking into bonds. Now, what's interesting, and I have down here the S&P 500 with dividends reinvested with the ticker symbol ETF. Notice that when this absolute panic happened, this is what happened to the stock market. Now, for context, just before, the S&P did fall almost 20%, but not quite, and then it broke out to new highs, and then it had a small correction. But just notice this was a very small correction here, and in fact the market was going up when this panic happened. Now guys, I understand this is super small, that's why I'm describing it to you. The next time the 10-year US Treasury had a panic and the yield went below 1.5% was in the middle of 2016. Now what's interesting about this is the S&P had just broken out to new highs after going sideways for 1 year. And it's really hard to see this right here, but there's a little oops where the market went back below and then broke out to new highs. And I'm now competing against the automated announcements. And then finally we have this 1.5% here that happened in 2019. Again, look down here to the S&P, what happened. The S&P, because look, the big fall started there and it ended there. Look what happened to the S&P during that time period. The answer is nothing. It went up a couple percent, it fell a couple percent, maybe a total of a 5% move, but that's nothing. And the reason I'm bringing up the yield is because the 10-year US Treasury is getting close to that 1.5% again. And I just find this really, really interesting because one of the ideas I've been having lately is that the bond market's lost its intelligence. And the reason I think that is because of these 2 price charts on this screen. So stick with me here because I know there's 2 price charts, but I'm going to tell you what's going on. So the top price chart is the 10-year German Treasury yield. So we got German rates on the top, and we got Japanese rates on the bottom. And the 3 red circles represent what the US 10-year rate was at during the exact same time period. The German rates are where they were. So when you had the US 10-year rate at 1.5% back in 2012, guess what the German rates were at? 1.5%, the exact same in 2012. No one says 2012, in 2012. And then fast forward to 2016, now German rates are at 0. I believe this is the first time ever in German history that rates are at 0 here. And in fact, you can see they're below the black line, which is 0. They're actually negative. Now, during that exact same time period, the US 10-year Treasury is still at that 1.5. But notice now the gap between these two. German yields are 0 or negative, and the US is 1.5% plus a little bit more above that. Now, the reason I don't have red circles down comparing this to the Japanese 10 years, because the 1.5% is not even on the screen for Japanese yields. It only goes as high as 1.4%. But we could do the same thing when yields, when the 10-year US yield was 1.5%, German yields were negative, and Japanese yields were really negative. Really negative is an economic term. Now you go to 2019, where there was its 3rd panic. okay, or the third kind of yield panic or bond panic, or oh my God, things are really scary panic. And again, look, German yields are even lower. The spread between the 10-year and the German 10-year is getting wider. And it's this what I think is driving US 10-year yields more than, say, scariness in the US stock market. Because think of this, on a global scale, you can put your money in a German 10-year today and make negative 40 basis points today, negative 40 basis points. Or, this is pretty incredible, you can put your money in a Japanese 10-year, do better, you can only lose negative 5 basis points. But first of all, guys, isn't that amazing? I mean, I need you to think about this. The German 10-year bond, which they call the Bund, is yielding negative 40 basis points, which is worse than Japan. What this is saying is Europe may be in worse shape than the Japanese stock market might be in. Now, if you run a global business, what do you want? Where do you want your money to be for 10 years? Yielding negative 40 basis points a year in, I was almost going to say the German mark, in the European euro, or do you want it in the US dollar, making you 1.5% a year, which is 1.9% better? So I think the Germans, okay, it's really the Germans. They're really the engine of Europe. The Germans are driving the US yield lower, more so now than even the Japanese. In 2016, it was the Japanese, but now it's the Germans. I mean, you know, World War II was kind of the Germans, the Japanese, and the Americans, the left fighting each other. And here we are again doing it. Okay, so what do you do with this information, right? Because what people are not taught, well, people are taught that, you know, take information, get confused, get complex, get overwhelmed. But what people are not trained is actually how to sort and filter information. Now that's outside of this posting, but what I want to say and point out to you is I don't think bonds are quite the stable place they used to be in the 80s and the 90s and even the aughts, which is a weird way to define a decade. And because there's such wonkiness in yields today, people are being thrown off, and in fact, they might end up getting hurt when yields snap back, right? Because if I go right back to the US 10-year, the yields moved up from each one of these panics, right? Moved up to about 3%, 2012 to the end of 2013. The 2016 panic moved back up to 3%. And so when that moves back up to 3%, there's a capital loss, right? Anywhere between 15 to 20% on TLT. So bonds are not risk-free. And the more we move past 2008, the more I think that fixed income, that bond market is not quite the canary in the coal mine that it used to be. All right, guys, this is RC Peck, and this is another step in helping you protect your portfolio and your future. Until next time, guys, take care.